Hello, this is Melissa Joy, and today we are talking about an investment update in the context of coronavirus, elections, and your money. I am founder and certified financial planner at Pearl Planning, located in Dexter, Michigan and Grosse Pointe, Michigan. And it's important to note that we are recording on the morning of February 27th. So the information that I have is up to that point. So today for our agenda, we are going to talk about coronavirus in the market, also current market conditions. I do think that part of what is occurring today is related to elections, so we're going to touch base on that. And then most importantly, your next steps as an investor with the information that we discuss in this meeting. Information in coronavirus is changing quickly. I pulled this Statista chart from early in the week. It's data as of February 24th. It's compiled by Johns Hopkins University, and you can see that coronavirus is being reported around the world. Notably, there is skepticism about the number of cases that are being reported in more authoritarian countries. So you can see China and Iran are dark red and orange, so higher levels of outbreak and per population. And they've also reported higher fatality rates, but some have thought that that might be because they were not reporting all of the cases, whether that was because they weren't able to test as many patients, or also just because information wanted to be controlled. So you're seeing lower fatality rates, closer to perhaps 1% in the rest of the world out of some of these more challenged or authoritarian governments. And a lot of the next steps are to get to understand more about how the virus is spreading. As of yesterday, which was Wednesday, the state of California had 2 locations that were reporting emergencies, both in Orange County and San Francisco. And late last night, we had the first report of a case where they were unable to trace where the person could have been exposed that has occurred in the US. So these are all relevant, but I would keep in mind several things. First, when you're thinking about this, I would focus more on your health and safety and planning for potential disruptions that might be related to coronavirus. So watch news and prepare to either work remotely. You may, if you have children and are a working parent like myself, prepare for what you would do in terms of the care of your kids or flexibility. Make sure that you have appropriate rations on hand. The CDC suggests that you should have a couple weeks worth of food and water. And then also in headlines in the Detroit Free Press today, there was an article about potential scams that are coming up and are associated with coronavirus. Be making cognizant decisions about what is going on and how you can be prepared. And certainly your decisions about your investments are related, but as we go through the rest of the presentation, I hope you understand that you typically would be working on a longer runway when it comes to your investments, so that you can focus on the day-to-day needs of you and your family during coronavirus and focus on the long term when it comes to your investments. So where are we at today? We have known about coronavirus since early January, and it started to present itself in China in December. And on the left, you can see information about how US markets is represented by the S&P 500, as well as markets around the world outside of the US in the red line with the MSCI index are reacting through the beginning of this week, through February 24th, to the news. So initially, things seemed to hold up pretty well in the US, as there was not movement outside of China, a more negative reaction around the world. And then we started to see markets decline more recently in the week of February 15th. And on the right, you can see information about US markets, which just this morning, the morning of February 27th, dipped into a 10% correction territory. It's notable that we had positive returns up to that point here in the US. So while the market has dipped into that territory, year-to-date returns for stocks are not quite that low. So one of the things that I think helps to provide some context is looking back over history when there have been outbreaks that were related to illnesses, diseases, viruses. And this is going back to 1980 with some significant headline type outbreaks around the world. Some of them may seem familiar to you, others less so because other things were happening at similar time periods. Typically, though, when you average price returns, and this is a measurement of the S&P 500, 6 months and 12 months after the announcements and news, the markets are typically up. So you can see an average price return of north of 8% over a 6-month period and an average price return of more than 13% over a 12-month period. Now, not all of that is because there was bad news in the market. Keep in mind that the other things were going on at the same time, and markets are up more often than they're down over 6 and 12-month periods. But I do think that it is important to know that headlines can be misleading, and sometimes the impact of downturns or pullbacks in the market have more to do with the uncertainty that's related to what's next as much as full market implications. And it also is relevant to think about where we were at going into these outbreaks. So I took this information from the end of last year, actually the end of January, information provided by JP Morgan, where we're looking at the US in gray, and you can see its big returns over the last 10 years. And then in purple is the international markets in general, as measured by that same MSCI index. And so in the US, things are relatively strong. The economy has been growing, and we have higher prices on our investments as measured by price earnings. Overseas, things haven't been quite as strong, and stocks have been relatively cheap. I think that is important to keep that context as we think about coronavirus. And then also, of course, the economy entering 2020, where you have information coming through. The world is trying to deal with fractured trading relationships around the world, and that has been a negative drag, especially overseas. But we were coming into the year thinking about the US economy with a low probability of recession. This information is coming from Raymond James, and while over the summer they thought there was about a 40% chance of recession, and I love dealing with probabilities versus just saying it's going to happen or it isn't. We had really good generally economic numbers and thought that there was potentially less probability of a recession coming into the year. So things were there were definitely challenges, but we are not impacted by a declining economy outside of this coronavirus as we can forecast or see it today. So at the same time that we have a public health outbreak, we have primaries occurring for the Democratic Party. And I think some of that news and information with Bernie Sanders being a front runner in the election is also leaking into the situation in the market. I took this picture from a headline from the New Yorker from 2015. So this is not a news story, and the title of that article was "The Populists." And I think that on both sides, both your frontrunner for the Democratic primaries as well as Donald Trump have populist tendencies. And so it's interesting to see how markets react to that. But I would encourage people to keep in mind that typically in a presidential election year, market returns are strong. Also, there's a strong focus from incumbents on maintaining the economy during election years. And it really matters not only what is going on in the presidential election, but also the House and Senate elections. And all of those lead typically to less occurring than markets may forecast or you may hear on the stump. So I think that is relevant as you consider the impacts of elections. We'll be talking more about this throughout the year as there's more clarity about both sides, who's running against who. So we'll keep that in mind, but certainly I didn't want to have an investment update without touching a bit on the election. So this is a look at a general map published as of January 2020 about where each state leans. It's certainly a toss-up, and there's no assumptions about what the outcome of the election will be. There's certain states that are really locked in one way or another, and we'll see what happens in those toss-up states. And there's a lot of focus on the toss-ups in the Senate as well for either party in terms of what gets done. And even when you have people in charge from the same party in both the House, the Senate, and the White House, it's not as easy to get things pushed through as you might think it would be. So major policy implications are to be determined. There's no certainty depending on who wins. So right now we're in near or in correction territory, and this is a publication from Ben Carlson from earlier this week about, well, actually it's from 2018, about big bad days, and it goes through market data going back over 90 years and talking about when there are really bad days and how that typically is in a situation where there's double-digit losses at the same time, and that's what we just entered here. So you can see, though, that these really bad days happen more often than you may think. So about 3 days per year have a plus 3%, and the volatility on the plus and the downside are typically associated with bad markets. Almost 4 days a year have a 3% or worse type of day. Almost 2 days a year have a 4% or worse, and about once a year there's a 5% or worse day. It's all part of being an investor in stocks. But we also know that while there are often and almost always intra-year declines, and this data is through February 25th, what you're looking at is on the bars, you're seeing information that is where the year ended up or year to date in the case of 2020. So year to date is negative with the blackest bar. And then the dots are how much of a pullback or correction happened within the year. So last year was an extraordinarily positive year, up 29%, but you can see that within the year there was a 7% pullback. Or the year before, while it ended negative 6%, when we're looking at the S&P 500, there was a 20% pullback during the year. So this is just a reminder that you're not, unless you're selling to cash, you're not locking in kind of the worst case scenario. And many years that have positive returns have significant pullbacks. So that's important to note. And it goes to investor behavior, reminding you to stick with your game plan, and hopefully that game plan is kind of memorialized in an investment policy statement or summary. And keep in mind that you should be investing to be consistent with your goals. So if most of your investments are tied to your retirement and you're still working, then you have years until the retirement. Plus, for most people that are retired, you know, they're living probabilistically into their 90s, so there's still a very long runway on the day that you retired, whether you're 60, 65, or 70. This all leads into information about time as an investor. So this is looking back at almost 70 years of data with information from investing in markets, and it looks at a mix of both stocks as well as bonds, and what happens over a 1 year period where things can be up or down. And I would say that anyone says that they can predict which year will be up and which year will be down is trying to sell you something and sending you on a fool's errand. But over time, as you add to the time of markets, things tend to, in the past, and past performance does not predict future returns, but things tend to be more positive and less potential to be negative. So we see a 5-year period where when you look at a portfolio of just stocks, the worst case scenario over a 5-year period in the 69 years is negative 3%, or the worst case scenario of a portfolio that is half stocks, half bonds is 1% positive. For a 10-year period, stocks could be negative, but the worst case scenario is -1%. And then over a 20-year rolling period, which is consistent with many people's timeframes or more, you typically have positive returns up and down. But how you get to those returns is maintaining consistency of your behavior during the down times. So what should you focus on when you make decisions about your investments? I love this information provided by Carl Richards and his famous Sharpie illustrations, but this is a look at 5 years versus 5 days, just for informational purposes only, but we strongly encourage you to focus on a longer time period. That will help your behavior, and it should also potentially help your results. So what actionable steps should you take to ensure that you are prepared for markets as they react in a difficult environment, such as this with difficult news about the coronavirus? First, do you have an updated financial plan? So all of your information about investing is tied to your financial goals, and I encourage you to make sure that you've been updating your financial plan. If it is updated, we talk with our clients about how that updated plan can provide flexibility and also provide you with information about how things are changing as markets and information changes. So if you don't have an updated financial plan, please go and get one. This can give you information about how to act and react when markets are changing. Also, keep an eye on your personal needs. So are you personally prepared for disruptions due to a public health threat? Are you making decisions that would reduce your exposure if there is an outbreak in your area? Also, just do the safe things like get your flu shot and wash your hands and anticipate those types of needs. And then finally, review your investment policy and maintain consistent decision discipline so that you are informing yourself on next steps in the context of your overall plan. Your investment policy should relate back to that financial plan that I mentioned, and it should be your roadmap for how you proceed going forward. If that's something that you really need, let us know. We can help you kind of get an overall picture of your approach to investing, your approach to risk, and develop a game plan that would make sense for you and your life. How can we help? Here at Pearl Planning, we have 2 offices, as I mentioned, in Dexter and Grosse Pointe, and those are both, Dexter's near Ann Arbor and Grosse Pointe is in part of Metro Detroit, but we also work remotely with clients in 17 states. So if you'd like to schedule a complimentary meeting to review your portfolios, don't hesitate to email me at melissa@pearlplan.com, PEARLPLAN.com, and we'll be happy to touch base with you and your needs and see if there's a fit if you don't have that financial plan or need that investment review. Also, if you sign up for our email newsletter on our website, we'll be happy to continue to send you information on markets in general as news comes out, as well as to keep you updated on financial planning topics. You can also follow us on Facebook or LinkedIn to get the same type of information. Thanks so much. Here's a little bit more contact information. Thank you for joining us today, and we look forward to helping you out as time goes on.